All right, Nate, are you on the line?
Yes, I am. How are you?
Awesome, awesome. We're doing well. We're excited and eager to hear your presentation. So, on that note, I'm going to hand it over to you, and if you can share your screen and go ahead and with your presentation.
Okay. All set?
All set. You're good to go.
Okay, great. Thank you, and thanks everyone for joining. Um, so, wanted to give you all some insight on a fairly unique business that we focus on within the multifamily apartment space. The niche that we operate in is called workforce housing, and I think there's a number of misnomers in the marketplace out there about what it is, how it works, why it's been so successful and become such a hot topic amongst real estate investors in recent years, and then talk about more specifically how we use our own blend of asset and property management and vertical integration to sort of eke out what we think are superior returns from this investment class and the ways that we go about it. So uh, we'll talk about a little bit about the firm, but I want to focus primarily on giving you some data points and some reference points as to how we operate, as well as try to leave quite a bit of time, if possible, for questions. I'm sure that people will have plenty of interest in asking me questions, and I'm happy to do that probably for at least the last 10 minutes or so of the allotted time here. So um, I'll also talk, I mean, of course, everybody has COVID and the related economic slowdowns on their mind as well. And we'll talk about how that's impacted us, in a minor negative way at first, but actually in a very positive way since, and I think also going forward, and we'll talk about some of the reasons why. And then finally, we do focus specifically on the Northeast, which is not something that a lot of folks do, certainly not the more institutional class of investors that we slot ourselves into, but there's a number of good reasons to be excited about the Northeast relative to some of the other regions in the country, and just the durability and sustainability of returns from what we're doing is quite attractive. So I'll talk about all of that as well, and again, leave plenty of time for people to ask their questions. So just quick by way of background, our firm has been around. Myself and my two partners have been working together for 10 years. So we're very seasoned specifically in this business, but also prior to that, having a number of experiences within institutional finance and various real estate and other operating businesses that we built, sold, grew, et cetera, over many years. And within this company, within one wall, we've done quite a bit of acquisitions in the last several years and grown from buying a 25 unit property in 2013 to having about 4,000 units owned and operated today. Along the way, spent about $600+ million of equity and debt capital to make those acquisitions, and have consistently delivered on our promise of whatever investor returns we were underwriting, as well as delivering very solid risk-adjusted returns relevant to multifamily and real estate more broadly, as well as within various different equity structures that we've utilized. And to date, no one has ever lost a dollar of equity from investing with us. So quick, synopsis of our backgrounds you can read at your leisure here. As I said, all of us have got a wealth of experience and really collaborate well with one another in terms of having complementary skill sets. The team is not just the three of us that run the show, but we've got a very solid infrastructure behind us in terms of the property management aspect of the business. And there's a decision out there between various real estate firms as to whether they want to be, where do they want to be on the value chain? Do they want to just invest money? Do they want to advise? Do they want to be an asset manager? Do they want to be a property manager? or do they want to do as much of everything as possible like us? And we've from day one always intended to have this vertical integration component, because we felt that if we were going to deliver our strategy, and be able to repeat our performance and do things in a regimented way that was consistent and delivered consistent results, that we really needed to control as much of the value chain as possible. So we've, over time built up quite an infrastructure behind the scenes as it relates to the property management side of the business. And within the last few years, as we've grown from 1,000 units to 2,000 units to 4,000 units, brought on some really high-powered management staff to our team. And the headline to this list here is our SVP of Property Management, Carrie, who came to us after a long, successful career at Home Properties, which some of you may or may not know was a very large public REIT that was acquired by Lone Star a few years back. She stayed on with them as they went through their sort of asset management and disposal process, and joined us after we acquired a 1,000-unit chunk of that portfolio in Pennsylvania a couple years ago. So I want to talk about shifting gears from that to helping you all understand what workforce housing is and isn't, and why it's an attractive asset class, and some of the parameters that we look at when we're evaluating deals, and also some of the data points that led us down the path of pursuing this strategy in the first place. So first of all, there's two terms out there: workforce housing and naturally occurring affordable housing. They're both trying to get at the same point, which is that there's a big chunk of the marketplace for renter households that are largely unserved by most of the activity that's out there on a development basis, as well as just the existing housing stock. And so you've got this segment of the population that we would consider working and middle class people that either by choice or by necessity can't afford, don't want to live in a home, choose to rent, and where do they fall on the income spectrum? So for us, the workforce demographic is really 60 to 120% of median income for the most part. So a couple years ago, median income was around 61,000. It's now in the mid 60s and has been growing. But most of our audience of renters, fall within the under 75,000 household income band, which correlates to them being able to afford rents that are somewhere in the $800 to $2,000 range. Our portfolios average around $1,200 rents, and you can see the differences, relative to what a lifestyle product might be, and that's generally speaking most of the Class A, development that you see, maybe in your hometowns or in the news, or the more institutionally owned products, REIT-owned buildings, that sort of thing. There's really very few people that can actually afford to live in most of those properties. Most of the people that do live in them end up moving out so that they can buy homes and stop paying rent. And so we have a much stickier audience who really has no access to the subsidies that are available in affordable housing, and similarly doesn't necessarily have the savings capacity or income generating capacity to move up the housing ladder and be able to buy a home, certainly in a lot of the urban markets, particularly in the Northeast. So, put a plug in here for the Northeast as far as how expensive housing is here. We're seeing a ton of migration out into the suburbs, but most of that migration on the housing side, which has been in the news frequently of late with COVID and everything else, has been at a very high price point. So the average renter that's either in an urban or suburban property that we own is not going out and buying a $400,000 plus house somewhere. So that's the audience. I started talking a little bit about some of the reasons why workforce housing is so attractive. Within that construct, there's this really massive supply-demand imbalance that's virtually impossible to eliminate. Some of the reasons for that It's really where construction costs are relative to how wages have grown over time, local regulatory hurdles, lack of land or the expensiveness of the land, NIMBYism as it relates to people in single family home dominated communities, not allowing apartments to be developed in their neighborhoods and so on. Just from, on a cost standpoint, the rents that you have to charge on a new construction project end up far exceeding what it costs us to buy an existing asset, add that basis to the cost of renovation and rehab, and we can do efficiency improvements and save costs, as well as make for a more economically sound investment as it relates to offering product to a larger audience of renters. And then there's also certainly people talk about gentrification and how that impacts the market. And so a lot of these, first and second ring communities in major employment centers, of which we have several in the Northeast, see waves of gentrification that's been going on for a while. And the rent growth that is an output of that really sustains rent growth at all of the different scales of housing. So when you look at your A, B, C classes, the more rent growth and development at the high end of that scale lifts up the rest of the market, and it makes it that much harder to supply the workforce product at a lower price point. Then on the demand side, we've got, as I said, many renters by necessity in this country, many in the Northeast, lack of job mobility and the affordability of homes, two big factors that drive the renter by necessity category. There's also this concept of renter by choice, where if you look at the demographics right now and the dispersion among older people and younger people and what social choices that they're making, obviously aging people are naturally moving up and out of homes when they become empty nesters, and the younger folks are both have a affordability issue, but also choose the flexibility of being able to rent as opposed to own, and many of these people are single and will be for years to come, and so it doesn't make a whole lot of sense to live by yourself in a 3,000 square foot house when there are plenty of rental options out there. And then I'll show a chart later about this last point regarding household formation from the adults that are currently living at home with their parents, and how that's creating a dramatic demand growth in the renter market going forward. And again, particularly that's an acute issue in the Northeast. And then, by its nature, housing, of course, is a human fundamental need. And, whether your workforce or luxury housing space, you need a place to live. And we benefit from trade down situations, certainly in economic environments like the current one, where people are trying to save money, or one of two partners lost a job and they don't have a choice but to go find a more affordable place to live. And then on just the inherent workforce demographic itself, when you picture who those workers are, think about education, medicine, and government employment, and the stability of those sectors. When we talk about nurses and teachers and government workers and blue and gray collar jobs where people actually have to show up somewhere, that limits their mobility. There's very few residents in our buildings that are deciding to move halfway across the country because they think they're going to be able to work remotely indefinitely. It's just not the case for a lot of these hands-on jobs that these people hold. And then, to some extent also there's that share of the younger professionals, which ties into the adults living at home and eventually moving out, and ties into the renter by choice lifestyle of just having that flexibility of an apartment, but also only having so much money to spend when it comes to housing. So some of it's just statistics. I'm not going to run through these, but just indicating, the large gap between what's being developed, that tiny little blue sliver of unit growth over the next several years relative to the amount of jobs within, the country that are demanding these corresponding rents that we're able to offer. Creates nice uplift opportunity on the value add of being able to buy, undermanaged, under market rented communities, and really improve those properties in those communities while still maintaining some affordability constraints. So we look at what the maximum affordability levels are, make sure we have enough of a cushion between that and what the current rents at the property are, and then over time as well, right? So there's, the blind value add approach is to say, okay, what would the building look like if if every unit got up to the market maximum rent, and we view that as not necessarily always possible, particularly when you have the constraints of whoever the existing local population is. And so we'll dive deeper into these numbers and say, what's the depth of the market? How can we maintain affordability while still also generating and driving rent growth and NOI growth? I talked about the different generations a little bit, and where they fall in sort of the scale of choosing to rent or not. Just want to point out a couple of things on this slide that I think are important to mention. I talked about single people. This demographic of mostly millennials in the 18 to 34 range, there's a little bit of a crossover with Generation Z in that age bracket as well. The unmarried proportion of that population has gone from 40 to 70% in the last 40 years. And so almost doubling the likelihood that those people will be renters. And then, the chart below shows, again, some of those natural affinity to renting, single people, married without children categories, far outpacing the other household growth categories. So it's not surprising that there would be such a gap in supply and demand in this particular audience of renters. And then on the right-hand side, there, of course, are people out there that make projections about, where they think the homeownership rates are going to go, and household formation and so forth. And one of the things that we've noticed in sort of deep research over the last couple of years is that we don't think all of those statistics actually take into account how the demographic makeup of the population changes the homeownership versus rentership preferences. And so I just illustrated an analysis here where, if you ask the typical prognosticator out there, they would say that, home ownership rates are rising, or at least biased to rise. And I think the exact opposite is true. And if we're right, there's another 10 or 20 million renter households out there that aren't really being accounted for from a development standpoint or otherwise by the marketplace, which is just going to further exacerbate the supply demand imbalance that we see in the market. I mentioned the people living at home. These are really pretty remarkable charts. The left-hand side is 18 to 29-year-olds living at home with a parent. And the reference point here is basically, go back to 1940 to see 48% living at home, and we've crossed over 50% in the last few months. And on the right-hand side, further breaking out that data in terms of the age brackets, race, and location. And sure enough, the Northeast is well above the even the average, being at the top there with 57% of 18 to 24-year-olds, or sorry, 18 to 29-year-olds, excuse me. And that's been climbing. It's been climbing everywhere, but you can see it's just a massive number of people, talking millions and millions of these young adults that eventually are going to get tired of their parents' basements and their childhood bedrooms. So Shifting gears into our portfolio, because I'm sure you all want to know, what have we seen in COVID times as it relates to property operations and so forth. And the answer is pretty pretty stark in these charts. So the first thing I'm talking about here is occupancy, and we've broken out the states that we operate in currently and some of the individual portfolios themselves. Naturally, there's always in the winter a little bit of a lower occupancy level than there is, on average across the year. So I put that reference point in there, which was in the kind of 93 to 94% range for us pre-COVID. And you can see that pretty much since April, we've seen occupancy shoot straight up. And for several months now, we've been more occupied than we were pre-COVID. We've got buildings that we can't even market because we don't have any units to lease to people. Things are very occupied. They have been consistently, 96, 97% occupied, 98, 99% leased. And in fact, one of the issues that's come up with the eviction moratoriums is having more demand for units simply because there's a natural amount of people that would normally move out or be evicted. And in some cases, we've gone the extra mile of actually buying folks out just so that we have units that we can rent to new residents that are obviously going to be paying and desire immediate move dates. And then on a collection basis, this is probably the more of more concern to most folks, again, evaluating whether they want to be in a particular investment or not. And again, you can see that, kind of April and May, sure, there was a little bit of a drop off. That was when everybody was in the fear and panic stage. And pretty much since then, even regardless of unemployment programs running out, regardless of no new stimulus passing, et cetera, you can see a pretty dramatic uptick in collection rates. The light blue bars here are basically the total collections, and the line is where we were pre-COVID. I'll also point out that February historically for workforce housing is the highest collection month, which you see is the case here as well. That's because many of the folks in this income demographic get tax refunds, and for those folks that fall behind on rent, February is a huge collection month for using those tax refunds. So we're even kind of skewed ourselves a little bit because those few months are pretty high collection periods normally. Nonetheless, we've caught back up and have even in some cases been exceeding by a pretty wide margin what the pre-COVID collections were. And economically, again, this sort of illustrates, I think, in a few different charts, the mitigation to the concerns out there about unemployment. Obviously, we've seen it come down dramatically. October, all the way down to 6.9%. Pretty consistent, reductions in new claims, continuing claims, et cetera. And one of the things that I'm always looking at as kind of a leading indicator to economic growth is the chart on the bottom right, which is rail traffic for the US. And you can see that the bottom here was really all the way back in the 16th week. So back in April is where the economy really bottomed. And so I wasn't surprised at all when we had 33% GDP growth in Q3, because I had already seen months and months of very substantial rail traffic growth here, which correlates very strongly to the underlying economic activities. And the red line for 2020, you can see it actually is above 2019 for the last several weeks now. So we'll see how things go. Obviously cases ticking up again, still some political uncertainty, but we've come a long way in terms of the economic recovery. And so I talked about our process a little bit early on in the conversation, and we've got this trademarked concept called multifamily alpha, which is really just an amalgamation of our proactive management style and the way that we operate and try to generate consistent and repeatable returns from the assets that we're investing in. So, on one hand, there's some fundamental underlying characteristics of the markets and locations that we're operating in that are outlined at the top here in terms of occupancy, renter households, affordability gaps, supply constraints, a lot of the things that I talked about already. And then when you get to the operational level, it's really figuring out, okay, where's this value add coming from? And what are the things that we can consistently do where we're optimizing the value and we're doing it because we're able to see things that other people aren't, or because we're managing them better. If we're vertically integrated, do we have more control over the process and so forth? And we can really, push these projects and business plans to the optimum level. And on the acquisition side, a lot of that is creating value on day one from just being able to purchase things for the right basis and the right locations, and also finding the right sellers. So there's particular sellers out there, operators out there we know that don't manage assets very well. We want to buy things from them because we can see low-hanging fruit on day one that we can improve on. And our first deal that we did in the fund was an example of that, whereby really there should have been a renovation plan in place. There should have been lots of effort put into curb appeal and deferred maintenance that were just being ignored by the seller. And so we came into an asset that was in the call it mid-80s occupancy in January, and despite basically owning it throughout most of COVID, have mid-90s occupancy, can't renovate units fast enough to rent them to people, and reduced work orders on the maintenance side by 90%, fixed all of the HVAC issues, and on and on and on. And these are things that have been accomplished, just in 6 or 8 months of a pretty difficult operating environment. So that touches on some of the other points here on the financial and operational side. So that intensive property and asset management that's in-house is super important for us to be able to consistently deliver, these types of performance track record. And getting on the financial side, getting in there and understanding where to spend money, right? So a lot of people ignore deferred maintenance because they don't think that it benefits them. But there's ways, from a utility efficiency standpoint and from a long-term cost-saving approach on maintenance and repairs, where if you put in dollars up front, you can actually save money in the long run. Being strategic about the renovations, I talked about the fact that we would take a moderate approach to rent growth and renovations to maintain and sustain rent growth over time, and to not alienate the community that we're operating in. So just a few examples. Not going to go through this slide, but just I'm sure people always ask about the track record and history of properties here. We've just in a handful of years already returned $125 million of equity capital, have basically been able to sell, recap, or refinance all assets that we've purchased in less than 3 years. Naturally doing that, because we achieved the upside that was necessary by that, early point in the cycle. And here's just an example of one of those deals that we're actually in the process of selling right now. Has a lot of the characteristics of the things that we look for, and I summarized at the bottom a lot of the acquisition value add piece in terms of the deal finding component and how much importance that has to just get out of the gates in a strong way. But basically, this particular deal was an institutionally owned asset that had a minority partner that really just was doing a poor job day-to-day operations of the property. Not in an easy, regulatory environment to operate in terms of dealing with rent control and local inspection regimes and so forth. But for the most part, good-looking properties that had some decent bones and could support much higher rents if anybody cared to give them good curb appeal and renovate some units and so forth. We walked into a situation with really high turnover, poor economic occupancy, really bad customer service, massive amounts of deferred maintenance and so forth. And really, the reason we got the deal in the first place was that it had been sold, tried to be sold multiple times, and nobody could get their arms around the diligence because it's a fairly sizable deal, and the buyers that were coming into the market to look at it didn't understand the operations well enough to realize that the financials that the seller had were meaningless. And so, we latched onto that. We had been operating in this market for a while, knew the ins and outs, knew where we could save money, knew where we could drive rents, came up with a really efficient plan, generated massive rent growth, going to realize a huge IRR, refinance the property to get all of our capital out in less than 2 years, and then less than 2 years later selling out to you know basically double or close to double the purchase price from just 3.5 years ago. And again, I won't go through all these details, but just some examples of all the deals that we've done and what the situations have been where we took advantage of the the sale process in some way or another. And 90+% of the deals that we've done have really been in these sort of dislocated process situations, or off market situations that we're able to generate discounted purchase prices, and then couple that with the additional financial and operational value add pieces to really drive growth and in value and income. So what we've started to offer this year as an opportunity to get involved in most of the deals that we're doing is launched a fund. And I talked about the durability of returns from just being focused on workforce housing and the consistency that we're able to deliver from an operational standpoint. On top of that, we sat around last year and said, what in this environment of very high asset prices, if you're looking at cap rates, if you're looking at asset prices over the last few years, they've been going through the roof. What's an opportunity we could offer to the marketplace to a wider audience of institutional folks that don't invest on a deal by deal basis? What can we offer to our individual investors that are really looking to have a portion of their portfolio tied up into a safer asset class, but still has exposure to the appreciation available in real estate, has non-correlation with the market, and drives double-digit returns? And so what we came up with is a structure that we used on individual deals, but converted it to a fund where the fund is investing in preferred equity within the individual transactions, getting the diversification benefits of doing that, setting some limitations on the risk that the fund is taking to preserve capital, offering it with really low management fees, very high preferred hurdle, so that people are really getting to keep most of the profits from what they're investing in, and then delivering a low double-digit IRR that's impossible to replicate with any other real estate related product at the same risk level. You don't often get a chance to invest directly in preferred equity as an investor, and the second lien products that are out there tend to have lower rates of return, and really don't see the benefit of the appreciating asset. And so we came up with this structure and have uniquely been able to offer this partnership alongside of individual investors, again, where preferred equity hasn't been widely available to the marketplace.
So Nate, there's a couple questions. One is, can we share your presentation?
Yep.
Okay. The next one is this a private placement or REIT structure?
It's an LP fund structure, so it's not a REIT. It's an LP.
Okay. And then the last one was, how could the potential changes to the 1031 exchange rules influence the number of mom and pop rental properties coming up for sale?
Well, on the 1031 side, obviously we don't know if anything's going to happen at all. I don't think we will until the first week of January, when the Georgia Senate elections are completed. If the Republicans keep the Senate, I don't expect there to be much, if any, tax changes coming down the pike. But if I assume the question is related to what happens if the 1031 goes away for these individual sellers. I think that it would naturally encourage those types of operators to refinance to pull capital out as opposed to selling. Obviously, if they're going to pay taxes on a lot of built-in gains that have increased many times over the last several years, it's not going to be as cost efficient for them to get out. I will say from our perspective, most of those sort of mom and pops that are driven by the 1031 desires are selling assets that are too small for us to focus on. We're trying to focus on the sort of 20 to $100 million purchase price deal set. We find most of those are owned by owner operators like ourselves, have some institutional involvement, syndication groups that don't operate on a 1031 basis because they have a bunch of individual investors and they're not structured in DSTs or otherwise to be able to benefit from 1031s anyway. So I don't see it having a lot of impact on us specifically. It certainly would reduce deal flow in the market if something like that went through, but it would again be more impactful on the smaller side of the transactions.
Awesome. Would you like to let everybody know how they can contact you?
Yeah. So actually, when you see the presentation, you'll have our contact information here. We have an investor portal, which is invest.onewellpartners.com. My email is simple. It's nate@onewellpartners.com. My extension's on there as well. Anybody wants to call me. I have a Calendly link as well. So for anybody that wants to reach out, schedule something, it's very easy to get. I can share my calendar and provide the times for that as well.
Awesome. Thank you so much. This has been a great presentation.
Great. Thanks, everyone. Appreciate it.